If you're like most people, you probably finance your home on a 30-year mortgage, and that is one hell of a long time to pay off a loan in full. In fact, just most people really never pay off a mortgage in their lifetime. But what if there was a way where you could actually pay off your loan in under 10 years or even under 7 years? Or maybe what about even under 3 years? Like, what would that mean to you, right? Not having a mortgage payment. How can you use that money for other things that are important in life? Investments, your family. Not having a mortgage loan, own completely your home free and clear. Just think about what that would mean to you. Well, if you actually like that idea, then in this video, I'm going to be showing you a loan program that is going to reveal how you can pay off your loan so freakingly fast. It's going to make your head spin. And really, guys, all I ask for this secret is for you to just simply tap on the like and the subscribe button for the YouTube algorithm and for yourself, and turn on post notifications so that you're always updated when I make a new video that can potentially help you save thousands of dollars in a very long time, just like this one. And today, I'm going to be talking to you about the all-in-one loan program. And odds are you probably never heard about this loan before. It's not, very popularized out there. There's not really many banks that do them. And you don't really see it on the news. You don't see it on TV. You don't see it really on advertisement online or anything like that. But before we actually talk about that program, I want to talk to you a little bit about what we already know, which is just regular mortgages and probably what you're pretty much already accustomed to, right? So maybe like a conventional loan, FHA, VA, USDA, a government loan, or, that has a fixed mortgage payment, such as a 30-year loan, or maybe even some of you have done 20-year mortgages or 15-year mortgages and that kind of stuff. So that's really all that you know. And let's go ahead and start with that so that we can come back and compare to the all-in-one program. And it's actually going to help you understand this whole thing even better. So regular mortgages are obviously kind of what they're offered out there, right? I mean, it's really, you walked into the bank and that's really what you got offered, a conventional loan or a government loan, right? And you walked out, you got the house and everything. But there are some major downsides to regular mortgages. And to me, there are basically three major downsides. The first one is regular mortgage loans front load interest payments on borrowers, basically meaning that you will pay interest on your loan first and then principal second. It's the reason why, for instance, you look at your mortgage statement and you see that you're paying about 2 to 2.5 times more interest that you do on principal. And it's also the reason why for instance, if you got a 30-year loan, you will pay so much more money on interest at the beginning of the loan that you, every single month when you're making a monthly payment, you don't ever really see that balance going down. Has that ever happened to you? It's pretty frustrating, right? And in fact, you really don't ever start paying a lot of principal until you reach probably about the 12th or the 15th year if you got a 30-year mortgage. So that to me is the biggest downside to a regular mortgage loan, but it's honestly the way how the whole amortization curve works. And, I'm going to give you guys an example. Say that, for instance, you have a $300,000 mortgage at a 4% interest rate. This will mean that you're going to have a payment of $1,432 on both principal and interest. So that will be your total payment, obviously not including escrows, right? Well, your principal payment will be just $432.25, while your interest payment will be $1,000, right? Like, how crazy is that? Now, over 30 years, you will have paid $215,607 just on interest payments alone. So you basically almost paying what the initial loan balance was on interest over 30 years. But now, sure, maybe you're going to say, listen, I'm never going to pay 30 years on this loan. But what if you just pay 7 years? Then really, after 7 years, your principal payments, you will have paid about $41,821. And on interest, you will have paid about $78,487 on interest payments. And that was just after 7 years. So just the first initial 7 years of the loan. Does that really sound like a good deal to you? I didn't think so. Now, the second downside is your principal and interest payment really just never changes. So for instance, you take out the mortgage and in a month, you make one big lump sum payment. Say you make a $10,000 payment into the principal because you want to pay off the loan a little bit faster. Well, guess what? Your principal and interest never changes. You always have a fixed monthly payment. So it doesn't matter if next month you make a big lump sum payment and then maybe 3 months later you make another big payment into the principal. Your principal and interest just never changes. What changed is obviously the balance of the loan. And obviously, yes, now you're going to be paying it off a little bit sooner because you've paid the balance so much faster, but literally nothing else changes on the loan. The interest doesn't change. It's still the same interest rate. The principal and interest payment never changes. You're still going to have the same principal and interest payment, meaning that your monthly payment is never going to decrease. So that is the really good downside as well. Now, to me, the third biggest point and the third biggest just issue that I have with regular mortgages is the inability to access your equity anytime you want. And every single month, obviously, you're making a contribution towards your equity, right? It's obviously you're making a principal payment. So part of that whole huge payment that you're making, a little bit tiny part of it goes towards the principal. That's obviously going to be increasing your equity level. Well, you really just can't grab your equity anytime you want it. The only way that you could actually do that is by either doing a cash out refinance, or if you take out a home equity line of credit. Both ways are actually a little bit not really advantageous, because if you take out a cash out refinance, just remember, you're going to be paying closing costs, which are typically about 2 to 3% of your loan balance, which obviously can be thousands of dollars. And it's not a process that you can just snap your fingers and you can close next day. It's a whole process. You still got to qualify. It closes in about 30 to 45 days. And the same thing goes with a HELOC. Now you can, on a home equity line of credit, you can take it and use your equity anytime you want, but you still have the fact that you have to apply for the HELOC and you got to get qualified, and getting qualified for a HELOC is not very easy. By the way, guys, if you want to hear about my top 5 HELOCs for 2021, click the little card above me. So to me, these are the 3 major disadvantages of regular mortgages. And now that we know these things, let's talk a little bit about the all-in-one program, because now you're going to be able to see that the all-in-one loan sort of changes the whole perspective about these 3 major downsides that regular mortgages have. So really, guys, in short words, the all-in-one loan is it's a first position HELOC with a fully transactional checking account component. And that's why it's called the all-in-one, because it combines all those things. So really, what does this do? Well, it actually accomplishes a couple of things. First, what it does is that it leverages your idle dollars that you might have in a checking or savings account, which honestly is probably just losing money, because as you know, APYs on savings and checking accounts are basically zero. So you're losing money due to inflation. And, basically what it does is it uses that money that you have idle somewhere and it applies it towards the principal balance of your loan, while at the same time, you're using your biggest financial component, which in my opinion is the ability for you to make money on a given basis. If you have a job where they give you a salary, you're making, money every single week or bi-weekly or every month, every year, whatever the case might be. If you own a business, you're obviously getting money from your business, hopefully. And if you are if you have commissions, then it's the same way, right? So you have the ability to create wealth every single month. So you're tackling your mortgage debt in 2 ways: by taking money that you have in one place and you put it into your mortgage account, and also by applying additional payments toward principal, which are going to accelerate the whole principal payoff. And guess what? You always have access to your money. So let's go ahead and give you guys an example, because it's going to be the easiest way to understand this whole concept. Say that you, for instance, you owe $300,000 today, but you have a checking account with $20,000, right? It's basically just in checking, doing absolutely nothing. And you're making $5,000 a month. All right. So if you take the all-in-one loan program, which has this checking account feature, which is fully FDIC insured, take the money that you have in savings, the $20,000, you move them into your mortgage account, and now you don't own $300,000. Now you owe $280,000. And then let's say that maybe in a week, you got paid your check, and your, net check from your job is $5,000. Well, now you don't owe $280,000. Now you owe $275,000. That's huge. Now you're seeing your principal balance drop completely. Again, you still have access to your funds. So it's not like you lost them. It's not like you can't come and grab anytime you want. This is the key about the all-in-one program, is the flexibility to use your money as you see fit. And here's the other kicker. Interest payments, interest calculations are based on a nightly basis. So if today you owe $285,000, the interest calculation is based on what the balance is today, and not what it was when you initially took out your loan, which is the other downside of a regular mortgage. So you have those huge things happening. Now you see that basically this all-in-one program is accomplishing you tackling your mortgage debt a lot faster, a lot in just bigger chunks, but also the fact that the interest payment is calculated on a nightly basis means that you are actually attacking principal first and then interest second. You see that? Because every single day, if your loan balance changes, your interest payment or your interest calculation gets updated based on that nightly basis. All right, so hopefully that actually made some sense. But you know what? Now let's go ahead and jump into the computer, because I'm going to be showing you a comparison between a regular, even a 15-year loan, and we're going to be looking at also what the all-in-one program is. So we're going to compare those two things right away so you can see the power of this whole loan program and how quickly it can help you become mortgage free. All right, guys, I'm in the CMG Financial all-in-one website, and I'm actually going to be linking this website on the description box below so that you can come and take your own simulator based on your own personal life. The first thing they're going to ask us is going to be a home's value, an estimated home value. So I'm going to say that it's $375,000 to make things easy. And really kind of what we want to do is we want to compare the all-in-one loan to a regular mortgage. And it could be the mortgage that you have right now, or if you're considering doing a refinance, then this will be a very useful tool. So say for instance, I have a loan balance of $300,000, and right now I'm thinking about refinancing basically. And somebody's offering me 2.625% interest rate on a 15-year refinance, right? Because I want to pay off my loan in full really quickly. Then we have a monthly payment of $218 every single month. And I have the ability to make extra payments. I'm going to leave that blank for now, because when you do a 15-year mortgage, your payment is going to go up quite a bit. So maybe right now I just don't have the ability to make any extra payments. Okay. Say continue. All right. So now we're basically going to be comparing that loan to the all-in-one program. Based on my life, say that I'm making $120,000 a year. That's just as an example, which basically means that my net income would be somewhere around $3,216. Yes, it's roughly after taxes and deductions and all that. I'm basically making $3,232. I believe it's $3,230. For $120,000 net. And I'm single. I don't have a spouse, but if you have a spouse, you can obviously put, other net deposits, that will come into the checking account for the all-in-one. But for now, I'm just going to say it's only me. And you can add somebody else, and you can add future lump sum deposits too. So this actually is very important. If you guys, for instance, you get commissions, or you get a bonus, you can put that in here, and it's going to help you guys see what power those additional lump sum payments will have on your loan. But I'm going to leave that alone for now. Now we're basically going to estimate the withdrawals. And, as you're using this as a checking account, obviously you're going to be depositing money, which is going to be based on your income, right? But also you do have expenses. You probably have a credit card payment or a car loan, or, you obviously have to pay your life somehow, some way, but, power and groceries and that kind of stuff. So that money is going to be withdrawn from the account. So let's go ahead and put a little bit about what that would be. And you can do either a percentage of deposits that are typically left over at the end of each month, or you can just do an itemized expense of bills and investments and things like that. I'm going to do the second one, which is the detailed itemization. It's a little bit easier for me. So I'm going to have the monthly mortgage payment of $2,018, but at the same time, I do have some credit cards. Say that I pay $300 a month on credit cards, and I have a car note for maybe $450 a month. and other monthly expenses. I don't know, this could be like groceries, it could be entertainment and things like that. So let's say that I'm spending about $1,200 every single month on those items. And I also have obviously the property taxes and the homeowner's insurance. I'm gonna go ahead and say that my property taxes are $4,000 a year and my insurance is $1,000. So I'm gonna have that annual expense of $5,000. By the way, with the Only One program, it is not escrow. Tax and insurance are not escrows. Those are separate. You have to pay your property taxes and your insurance separately. So that's what we have going on. I don't have any other expenses right now. And basically now the system is going to calculate my deposits, my withdrawals, and basically every single month I have 37.3% of my money left over that will be put into the Only One account. All right, so here we go. So we basically have the comparison. It's very detailed. The Only One loan says that if I continue my life the way that I am with the new Only One loan, I will be able to pay off the mortgage in 6.2 years while saving me $18,231 on interest, compared to a regular 15-year loan where basically will be 15 years. So I'm actually paying off the mortgage in 9 years faster, basically. My minimum monthly payment will be $608. That's interest only. Guys, HELOCs, just like the Only One, which is basically a HELOC, is going to be interest only minimum payment. So that's $608. And every single month, I'm going to be bringing my principal reduction down to $4,000. Now, obviously, this compared to a regular 15-year mortgage where my payment is going to go up and it's just, one, payment that I know it's going to be every single month. Now, moving on to the cost summary, I'm going to be reducing the principal by 16.2% every single year. That means that, the amount of deposits that I'm making into the Only One account will reduce the principal balance by 16.2% every single year. I'm going to be paying about $45,000 on interest just overall on the total mortgage, which literally, $300,000 to pay $45,000 on interest on $300,000. That's basically nothing. 15%, basically $45,000 is 15% of the $300,000, and it's using a estimated interest rate of 5.955%. I'm going to be talking a little bit about what that means. The interest rates on the Only One towards the end of this video, but this is also pretty crazy, and this will definitely show you that just having a low interest rate doesn't mean that you're paying the least amount of interest. That doesn't mean the same thing, and people who are financially savvy understand this. For the 15-year loan to compare to the Only One loan program, it means that really the 15-year loan will have to have an interest rate of 1.9% to achieve paying $45,000 in interest. You guys see that? So the break-even interest rate means that if rates were to keep going up and up and up, the Only One program will not be as beneficial as the 15-year loan if it goes past 6.335%. Again, let me talk a little bit more about what the interest looks like on the Only One loan program. But as you guys can see here, and there's more graphs, you can come in and just play around with these things so you can get a better idea based on your own financial situation. But this is nuts, the fact that you're paying off the loan in 6.2 years, and that's just on my, example. If you have the ability to make even a lot more money, especially those who are high income earners, or, if you have commissions or you have, bonuses and things of that nature, especially if you have money just sitting around somewhere, this loan program will be a huge help for you, where you can just be completely free in such a short amount of time. It'll completely change your life. All right, so now that we've gone through an example, I want to talk a little bit about who this program is for and who isn't really suited for. This to me is a program that is suited for people who are financially responsible, who don't live above their means, who are not living paycheck to paycheck. They're not having issues paying their, mortgage, and maybe right now they're paying more money towards the mortgage because they want to pay it a little bit faster. This is for people who really have control of their finances, and they want even further control over the biggest debt instrument that they have, which will be the mortgage, obviously. It obviously gives you the ability to use your equity any way you want. So this will be huge for people who, have investments or have, investment ideas, or maybe even, for instance, somebody such as a real estate investor. This will be extremely good for, because the Only One program gives you the ability to use your equity for purchasing other properties. But not only that, if you're a real estate investor, you can actually get the Only One program in a primary home, and you can get it on second homes, and you could get on even on investment properties. This is a HELOC, and if you guys have any experience getting HELOCs in the past, then you probably know that you cannot get a HELOC on an investment property, but the Only One program does allow you to put it on an investment property. So for some of you who have rental properties, investment properties, then this will be a really good option for you to take equity from those homes and leverage them to buy other homes. Now, who this isn't really for, obviously this will be for somebody who doesn't really have complete control over their spending habits. This loan program would probably, it can probably trigger spending sprees, because once again, you have complete control over your home's equity, and it's a lot of money. So if someone is not really making more contributions towards their equity based on what they're withdrawing, then this loan program will be not for them. So if you feel like you're not financially responsible, you are living a little bit paycheck to paycheck, then I would steer away from this program, because it wouldn't really be the best thing for you. Also, with this kind of loan, a little bit, just to kind of summarize towards the end, a few things that you need to understand. HELOCs are basically just like credit cards, okay? So not only you have the revolving, expense component to them, where you can basically use them anytime you want. You can pay it off in full. You can use them and pay them back in full again. This is the same thing. So the Only One loan program, say that if you don't have a balance on the mortgage, well, in maybe tomorrow you need to access $20,000, $30,000 to make an investment in something else, and then in 2 months you can pay it off. You can definitely do that. There's no fees, there's no penalties for paying off the loan early. It's actually encouraged for you to pay off the loan early. It's a 30-year loan with a 10-year draw period, meaning that you have 10 years to use it as a revolving account. Another thing that you definitely need to know about this program is that it's just like every HELOC is based on a variable interest rate. So if you're looking for a fixed interest rate, it does have that feature. You can actually get this loan on a fixed interest rate, but I don't really recommend it, because taking out a fixed interest rate over the 30 years on this loan, you will definitely have a much higher interest rate than just doing a variable interest rate. And right now, the interest rate is based on the LIBOR, which has been historically very, very low. Now, the LIBOR is getting phased out this year, I believe in 2021. As of right now, there's not a set index where this is gonna get pegged to, but once I know what that is, guys, I'm gonna be putting it on the description box below, and in the comments I'm gonna pin it so that you guys know what that is. But as of right now, it's still the 1 month LIBOR. Finally, I think thing that you guys should know, there may be other options. Something that a lot of people ask me are, well, why can't I just go and get a HELOC and accomplish this the same way? You could do that, but there are some downsides to regular HELOCs. First of all, HELOCs are not necessarily instruments to help you pay off your loan faster. They're mainly instruments to just provide a quick solution for you to grab equity as you need to. There's also the inherent problem with a HELOC, where basically it doesn't have the checking account feature. And that whole checking account feature to the Only One program is really huge, because it literally, in a way, it works psychologically on you, because you are going to be seeing how much faster you can actually tackle this mortgage without you really realizing it. Because it's not like a 15-year loan where you're having to increase your mortgage payment so much so that you can pay off the loan faster. But in fact, it's just you using your biggest financial weapon, which is making money on a given basis, as well as using your idle money to bring down the balance faster, and all of those things which you still have very much access to. So to me, it's a really wonderful program. And by the way, guys, if you need to know a little bit more information about them, I am going to be putting links on the description box below. There you guys have it. Hopefully you liked the video, and hopefully it was very informative. And maybe even if this is not a thing for you, at least I'm hoping that it gives you another idea on how you can actually accomplish complete mortgage freedom. Let me know in the comments below kind of what you think about it, any feedback that you have, if you've done this loan before, or if you're considering doing this loan, or if you have any questions, just put it in the comment box below. My name is Marcos. Thank you so much for watching, guys. Until the next one, goodbye for now.